Welcome to the Explainer. Now, if you've been tracking the AI boom, you've probably heard one name absolutely everywhere: NVIDIA. But what if I told you there's a massive, multi-billion-dollar battleground happening, literally one layer deeper in the AI infrastructure stack? Today, we're zooming in on this next layer, the explosive market for custom AI silicon. This is exactly where the world's biggest tech giants go when off-the-shelf, general-purpose GPUs just aren't cutting it anymore, or, honestly, are just way too expensive to run at a massive scale. Okay, let's dive right into this. So here's our roadmap for today's breakdown. We're going to start with the custom AI chip boom, meet the silicon contenders, dive into the actual custom chips and interconnect tech, crunch the numbers on earnings and scale, analyze their competitive moats, and finally, figure out which AI stock actually wins.
All right, Section 1, the custom AI chip boom and how hyperscalers are shifting their spend.
To really grasp what's going on here, we've got to look at how the hyperscalers, Google, Meta, Microsoft, Amazon, are drastically shifting how they spend their billions. It begs a huge question. Is NVIDIA really the only way to play the AI boom? I mean, the mainstream narrative definitely makes it seem that way, right? But behind the scenes, these hyperscalers are running into a massive math problem. Look, general-purpose GPUs are amazing, no doubt. But they're incredibly expensive and they just devour power. So to save money and really optimize for their highly specific workloads, these giants are essentially taking matters into their own hands. They're designing their own custom chips. The catch? They can't physically build them alone.
And that brings us to a really crucial concept. Let's bust some jargon right out of the gate. You're going to hear the acronym ASIC thrown around a lot. It stands for Application-Specific Integrated Circuit. Unlike a general-purpose GPU that can kind of do a little bit of everything, an ASIC is a hardwired chip that's pre-programmed to do one highly specific task and literally nothing else. Because it strips away all that extra unnecessary functionality, an ASIC offers some massive cost and power advantages for a hyperscaler that's running the exact same AI workload millions of times a second. Moving right along to Section 2, meet the silicon contenders, Broadcom versus Marvell.
So, while the hyperscalers handle designing the logic for these ASICs, they desperately need partners to turn those blueprints into physical chips that actually work at scale. In one corner, we've got Broadcom, ticker AVGO, and in the other, Marvell Technology, ticker MRVL. And looking at the numbers brilliantly illustrates the sheer size difference here. Broadcom is the absolute Goliath of the space. We're talking a towering $2 trillion market cap, holding roughly 60 to 70% of the entire custom ASIC market. Marvell, on the other hand, is the David in this scenario. They're a $149 billion market cap challenger. But hey, do not let that size fool you. Marvell is growing its custom AI ASIC revenue at a totally astonishing 60% year-over-year rate.
Because despite being the smaller player, Marvell is definitely no startup. They've got a massive $8.2 billion enterprise scale. And what's absolutely crucial to understand about Marvell right now is their rapid evolution. Over just the last 2 years or so, they've aggressively pivoted from being this diversified storage and networking supplier into a highly focused, pure AI-centric design partner. They're heavily building out their infrastructure and expanding their physical footprint to take on the Goliath.
Okay, Section 3, Custom Chips and Interconnect Tech. Let's get into the hardware.
Now, what's really interesting here is how they actually build these things differently. Marvell uses a highly advanced 3D layered chiplet platform architecture, which really contrasts with a more traditional flat ASIC layout. Instead of trying to build one massive monolithic chip, which, by the way, can be ridiculously difficult and expensive to manufacture without any defects, Marvell is going all in on a chiplet architecture. Basically, they're stitching together smaller, highly efficient chips, or chiplets, often using cutting-edge 5nm or 3nm processes.
But look, building the chip is honestly only half the battle. Getting them to communicate with each other at lightning speed is just as vital. Broadcom relies heavily on its deep leadership in SerDes technology, that's serializer/deserializer, along with their advanced 2.5D and 3D packaging. This makes their chips incredibly power efficient. Now, Marvell takes a slightly different angle. They're the undisputed market leader in optical connectivity and DSPs, or digital signal processors. They also lean heavily into deep PCIX and CXL switching integration. Actually, Marvell holds specific patents like US 11-86027B2, which directly integrates PCIX logic right into Ethernet switches for ultra-low latency. And in AI training, low latency isn't just nice to have, it is an absolute prerequisite.
Which brings us to Section 4, Earnings, Margins, and Scale. Let's look at the financial matchup.
All right, so we've geeked out over the hardware schematics. Now let's pivot to the spreadsheets and see how this tech translates to Wall Street. Here's a side-by-side comparison based on analyst estimates. Broadcom's scale is frankly just staggering. They're projected to hit over $104 billion in revenue for fiscal 2026. Compare that to Marvell's $8.2 billion. And because Broadcom is just so utterly dominant, the market prices it at a premium. Its enterprise value to revenue multiple is over 14x, compared to Marvell's much cheaper 9.4x. But you've got to look at those margins. Broadcom is cranking out gross margins between 65 and 77%. Marvell's is hovering around 50 to 51% right now, though to be fair, management totally expects that to rise as their custom programs really start scaling up.
So the really crucial point here is this number, 106%. That represents Broadcom's staggering year-over-year growth in custom AI chips in Q1 alone. We are talking $8.4 billion for just that single quarter. In fact, Broadcom anticipates its custom AI chip business is going to help propel the total company revenue to well over $100 billion within the next year. It's just a massive, wildly accelerating flywheel.
All right, let's hit Section 5, competitive moats and customers. How do you defend that flywheel?
So how do you actually protect a flywheel moving that fast? Well, think of their business models kind of like two very different high-end restaurants. Broadcom is offering the fixed menu. They provide an end-to-end solution that's super closely tied to their massive networking portfolio. It's incredibly highly optimized, and once a customer buys in, they become deeply integrated and basically locked into the Broadcom ecosystem. That stickiness is exactly what won them massive partnerships like Google's TPU, Meta's MTIA, and OpenAI. Marvell, on the flip side, is the a la carte buffet. They appeal to customers who really want more control over their own specific architectures. They provide these modular components, like their optical connectivity, that just plug right into a customer's existing designs. And this highly flexible approach has secured them some massive design wins, like Amazon's Trainium chips and Microsoft's Maya accelerator.
And just to understand how powerful these moats really are, listen to this analyst quote reviewing Broadcom's recent performance. 3 straight years of data center revenue growth compounding at well over 40%. Honestly, when you have hyperscalers locked into your ecosystem, and those same hyperscalers are battling it out in an absolute AI arms race, your revenue doesn't just grow, it compounds at completely historic rates.
Let's move to our final section, Section 6, which AI stock wins? Time for the final verdict.
Based on the analyst projections we've dug into, it really all comes down to risk versus reward. For Broadcom, the bull case is pretty crystal clear. It's a high-margin compounder with incredibly sticky, locked-in clients. It's basically the safe growth play with amazing visibility straight through 2028. The bear case? Well, the valuation multiple is already pretty sky-high, which means if hyperscalers suddenly decide to slow down their spending, the stock could definitely take a serious hit. Now, looking at Marvell, the bull case here is that it's a high-beta, pure-play AI growth story. It's significantly cheaper on a revenue basis, leaving massive room for upside if they can just execute. The bear case? It's much higher risk. They're way earlier in their AI ramp, their margins are still recovering, and let's face it, they still have a lot to prove against the undisputed giant in the room.
At the end of the day, both of these companies are riding the wave of quite literally one of the largest infrastructure build-outs in human history. This custom silicon market isn't just a zero-sum game, but how you approach it depends entirely on your own investment thesis. So, looking at the data we've unpacked today, what's your move? Do you prefer locking in with the safe, predictable giant that already dominates the space, or are you willing to bet on the high-risk, high-reward challenger with a massive runway for growth? Let that sink in for a minute, and definitely keep an eye on this hidden layer of the AI boom. Thanks so much for joining me on this explainer, and keep learning.